Hi there, and welcome to this workshop session on financial math. My name is Heinrich, and I'm going to be working with you today in order to demystify this thing that we call finance. So, if I can give you only 3 tips, it would be to, number 1, draw a timeline. Now, a timeline is such a crucial tool because you can put in the cash flows, the money that gets paid or received, you can put in the periods, you can note changes in interests, and basically what happens is all the information that ends up going into the formula can be first represented on the timeline, and that's going to help you to make sure that you actually put the right thing into the formula. So number 1, draw a timeline. Number 2, sketch the events in a chronological and a linear fashion. In other words, please draw a timeline. And then number 3, construct a diagram with no curves or corners, in other words, a line, indicating the size and the timing of cash flows. So in other words, draw a timeline. Okay, so we've got formulae that we need to use, and we need to know when to use those formulae. So the first set of formulae is for when we only have 2 cash flows. Now, 2 cash flows basically means there's an accumulated amount, which is some amount in the future, and a principal amount, what we call P, which is some amount today, right? So that's all there is. There's money today, and we want to know what's it going to be worth in the future, whether it's increasing in value, if we're earning interest, or something that's decreasing in value, like depreciation for assets, right? So our first formula there is for simple decay, or for linear depreciation is the other word that we use that for. And then the next up there is for linear appreciation. So that is then simple interest. And then after that, that's the one that you're going to use most frequently. That there is compound interest. And then below that, we've got compound decay, which is basically what we use when they say use the diminishing balance method or the reducing balance method or something like that. Okay, so that's familiar. We dealt with that in grade 11. And then we've got this thing called an annuity. Now, an annuity is a series of regular cash flows. So what do I mean by regular? Well, regular means that the cash flows themselves are going to be the same amount, and it also means that the timing between the cash flows are going to be the same. So the cash flows are either going to happen every month or every year or every week, whatever the case may be, but those cash flows have to be regular, right? And then the whole series thing just means, well, there's more than one. Okay, so if you only have one cash flow, well, that's not an annuity. See the other side of the screen for that. Okay, so if we have a present value annuity, we're going to use that formula there. And if we have a future value annuity, we're going to use that formula there. And we're going to have a deeper look at how to use these formulae. Right.